Alright, Assalamualaikum to Madam Farah. Thank you very much for watching this video. My name is Imran, and basically in this video we are going to be presenting to you about the two companies that we have chosen for us to make a comparison on the financial health as well as on the financial analysis of these two companies that are listed in Bursa Malaysia. My name is Imran, and further of this presentation will be conducted by my next teammate, which would be Arina Shazlin. So I would be talking about the introduction, the strengths, weaknesses, and a bit of the technicalities of the companies, as the mathematical technicalities will be further discussed between me and also Arina Shazlin further down the road in this presentation. Thank you very much for watching. Let's begin. To begin with the self-introduction, I just would like to inform Vitrox Corporation is one of the companies that we have chosen. Now, this is a Malaysian company that is listed on Bursa Malaysia. It is a very well-known company for its automated vision inspection systems, their machine vision solutions, as well as their advanced analytics software. Although those are their specialty, but their core activities, they do cover a whole cycle of research, development, manufacturing, sales, customer service, after sales support, and also what is known as a turnkey automated solutions. Now, one of their key products could be, no, not could be, one of their key products are actually categorized as AOI, which stands for Automated Optical Inspection, and then we have EXI, Automated X-ray Inspection, and metrology tools, mainly serving the semiconductor packaging, PCB assembly, and electronics manufacturing industries. And as a competitive front, this company, it does face a lot of global players like Koyang, Nordson, Sonoscan, and other companies as if like Teradin. Locally, the competition mostly comes from other machine vision suppliers and automation system integrators. So I would say the company is more to inclined towards competitive that is done globally rather than locally within Malaysia itself. Moving on further, we have the next company, which is Inari Amutan Berhad. Now, in this company, just like Vitrox, it is also listed on Bursa Malaysia, but it operates in a different part of the semiconductor value chain. Now, what do I mean by that? Inari is an actually outsourced semiconductor assembly and test provider, or what is known as OSAT or SAT, and it also provides electronics manufacturing services. That means their activities would mostly include contract manufacturing, semiconductor assembly and testing, as well as module packaging. They do also handle surface mount assembly, package testing, and logistics, but like I said, they are mostly more inclined towards the former part of this presentation. And then we do have Inari's customers. They are mostly in OEMs, in communications, consumer electronics, and also industrial applications. But on a global scale, they do compete with big names like ASE Technology and Amcor Technology. But locally at the same time, they do face the Malaysian contract manufacturers. Now, let's talk about some of their strengths. They do have cost efficiency. They also have large-scale manufacturing and very long-term customer partnerships. To the next part of this presentation, which is the SWOT analysis. Here's a quick look. We are going to begin with the strength. Number one will be they do enjoy a strong market position. That means their healthy profit margin is above certified 23%. That means they also have high liquidity with the current ratio above 7 and a very low debt levels. That means their weakness on the flip side, there will be a slight decline in their quick ratio because they actually do rely heavily on very few major customers, and there's been a small dip in operating profit margins. In that case, if they actually lose the customers, then the health of the company financially will actually go down very badly. As for opportunities, there's a lot of room for growth if you ask me personally. In terms of that, they can actually expand to China, and this expansion to China would definitely increase global demand for semiconductors driven by AI, IoT, as well as 5G. As we all know, we are actually living in a digitalization era of artificial intelligence. And when it comes to threats, I wouldn't so much consider this as threats, but of course, they do face risks from cyclical downturns in the industry. For example, foreign exchange fluctuations and actually a strong global competition in semiconductor packaging. But I would say they could use this as a very more part of opportunity for them to market their segment and also to work on their research and development. As for Vitrox company, this company, they do have a very big presence in more than 35 countries. That means they have a very strong cash position. Okay, that means they do also have a healthy current ratio above 5, which allows them to have a very low debt under 20% and consistently high gross margins of over 60%. Weakness-wise, however, their revenue and profit took a hit in 2024, which could be noticed in their financial statements. With profit of their tax dropping by 30%, that shows their capabilities in terms of keeping the profits after tax deductions is a very hard challenge for them to keep track of, and also for them to overcome in terms of keeping the financial stability of the company at a very healthy stage. Now, their receivable days also increased to over 150, and they remain heavily dependent on semiconductor demand cycles. That brings us to the next one, which is the opportunity. The future looks is very promising. Although the rising demand for AI-driven inspection system, large cash reserves, and whatsoever which they can channel into R&D, all of this allows them to fight the threat, which is like Inari, which means they are exposed to cyclical downturns in terms of the electronic sector, currency risk, and competition from other global machine vision providers in the whole world basically. So if the company they are quite smart enough in order for them to do research and development and understand all the fluctuations, all the currency exchange rates that happens on a regular basis, all the exchange rates, the fluctuations and whatsoever, they can play it at their advantage when it comes to promoting and also when it comes to providing value to the customers.
My name is Irina, so I will present to you about the ratio analysis for Inari Emerton 2023 and also 2024. So, looking at the Inari's financial ratios, liquidity, in 2023, current ratio is 7.40. However, in 2024, it rises in 7.31. For quick ratio, 6.94 for 2023 and 6.87 for 2024, which is its decrease. So both are extremely high compared to industry norms, showing a strong short-term solvency. Next, asset management, which is inventory turnover stable at 7.06 to 7.07 times. Asset turnover improved from 0.44 to 0.45, which is average collection improved from 48.5 days to 46.4 days. However, receivable turnover increased from 7.52 to 7.86, and non-current asset turnover rose from 1.34 to 1.39. Next, we look at profitability, which is gross profit margin, improved from 33.6% to 34.9%. Operating margin stays around 30%. Net margin stable around 33.9% to 23.8%. ROA steady at 10.9%. ROE improved slightly from 11.7% to 11.9%. For leverage, debt ratio 9.0% to 9.3%. Time interest earned improved from 90.4 to 108 times. So this concludes that Inari shows excellent liquidity, stable profitability, very low debt, and improved receivable management. Next, the ratio analysis for Vitrox Corporation 2023 and 2024. So for liquidity, current ratio improved from 5.19 to 5.56. Quick ratio also improved from 3.91 to 4.20. Both are strong. For asset management, inventory turnover slightly improved from 1.07 to 1.11. Total asset turnover fell from 0.49 to 0.46. Average collection period worsened from 121 days to 157 days. Receivable turnover dropped from 3.01 to 2.33 times. non-current asset turnover declined from 1.58 to 1.43. Next, we will proceed to profitability, which is first, gross profit margin declined from 62.9% to 59.5%. Operating margin dropped from 24.6% to 18.7%. Net profit margin decreased from 22.2% to 16.2%. ROA fell from 10.9% to 7.4%. ROE dropped from 13.4% to 8.8%. For leverage, debt ratio decreased from 17.8% to 15.5%. Time interest earned fell from 35.5 to 30.7 times only. So here we can see that VITROX maintains strong liquidity and low debt. However, profitability has declined and receivable collection has slowed significantly. So now, let's take a look at the cross-section analysis for 2023, comparing Inari, Emerton, and VITROX. So for liquidity ratios, both companies have very high liquidity, well above the industry norm around 2. Inari current ratio is 7.40 and quick ratio of 6.94 are higher than VITROX, 5.19 and 3.19. So, which means Inari is in a stronger position to cover short-term obligations. And for asset management ratio, Inari show much faster inventory turnover at 7.06 times compared to VITROX 1.07 times. So this indicates that Inari is more efficient in managing and selling its stocks. Inari also collects receivable much faster with an average of 48 days versus VITROX 121 days. However, VITROX performs slightly better in total asset turnover at 0.49 compared to Inari's 0.44. And also in non-current asset turnover, meaning it uses fixed asset more efficiently. So, profitability ratios. VITROX has much higher gross profit margin at 62.9 compared to Inari's 33.6%, showing stronger pricing power or cost advantages. But when looking at net profit margin, Inari slightly outperformed at 23.9% compared to VITROX 22.2%. So VITROX edges ahead in ROA and ROE with 10.9% and 13.4% compared to Inari's 10.6% and 11.7%. So for leverage ratios, both companies are low in debt, but Inari has a lower debt ratio of 9% compared to VITROX 18%. Time interest earned is also much higher for Inari at 90 times versus 35 times for VITROX, showing that Inari has a much greater ability to cover interest expenses. So overall, for 2023, Inari shows stronger liquidity, faster cash collections, and stability, while VITROX has better gross margins and efficiency in using assets. So this highlights how Inari is stronger in financial safety, while VITROX is stronger in technology-driven profitability. So, moving on to the cross-section analysis for 2024, comparing Inari and VITROX again. So, liquidity ratios, both companies maintain very high liquidity above industry norms. Inari's current ratio is 7.31 and quick ratio is 6.87, while VITROX are 5.56 and 4.20. So this shows that both are financially healthy, but Inari is slightly stronger in short-term solvency. Asset management ratios. Inari's inventory turnover is 7.07 times compared to VITROX, which is only 1.11, showing that Inari is much faster in moving inventory. And Inari also collects receivable far quicker at 46 days compared to the VITROX 157 days. However, VITROX makes better use of fixed asset with a non-current asset turnover of 1.43 compared to Inari's 1.39 only. Moving on to the profitability ratios, Vitrox maintained a much higher gross profit margin at 59.5% compared to Inari's 34.9% only, and showing strong products pricing power. But Inari outperformed in operating margin at 30.2 versus Vitrox 18.7%, and also in net profit margin at 23.8% compared to Vitrox 16.2% only. So Inari also generates better returns on assets and equity, with ROA of 10.6% and ROE 11.9%, while Vitrox recorded 7.4% and 8.8% only. And last but not least, leverage ratios. Both companies use little debts, but Inari is safer with the debt ratios of 9.3% compared to Vitrox 15.5%. Time interest earned is also much higher for Inari, which is at 104 times, while Vitrox is at 31 times. So overall, for 2024, Inaris continue to show stronger liquidity, profitability in terms of operating and net margins, and also safer debt positions. Vitrox, on the other hand, still holds on edge in gross profit margin due to its technology-driven products, but faces challenges in receivable management and also profitability.
Now, as a conclusion, I would like to conclude that both companies are actually they are strong, but they do operate in both unique ways and different parts of the value chain. They have their own ways of managing their companies. They have their own ways of operating their own companies, and of course, for Vitrox, they do focus on high tech inspection equipment. They do offer higher margins, but they're also facing cyclical demand and profit volatility, just like Inari does. Okay, but Inari, on the other hand, they do emphasize more large-scale outsourced assembly and testing, as well as what we call as offering stable revenue, scale, and lower risk. So, based on all this, the strength, the SWOT analysis that I've given to you previously, we could actually come to a conclusion that Inari Amartan Berhad is a very huge recommendation, or a highly recommended as the stronger investment candidate due to its multiple reasons of being its scale, stability, their exposure, and growth potential in terms of global semiconductor outsourcing. As a team, me and Arina, we would definitely vote for Inari Amartan. In one word, I would say Inari Amartan would be a very good return on investment. Thank you very much, madam. Have a good evening. You have a good day ahead. Thank you for watching our presentation. Bye bye. Now, as a conclusion,